Hello traders, today we are going to talk about basic candlestick pattern. Number one is bullish pin bar. A bullish pin bar is a strong reversal candlestick pattern. It indicates a potential reversal to the upward. A bullish pin bar consists of three elements, which are number one, small green body, number two, a tiny or no wick above the body, number three, a large wick below the body. Let's understand the psychology behind this pattern. A bullish pin bar shows the price open around here. Instantly, the, the sellers tried to take the price down. They were able to push the price down, but at some point, the lower price is triggered buyer from the buyers. The buyers were significantly stronger than the sellers as they push the price beyond the open. Therefore, if you think about it, the buyers covered more distance than the sellers. It indicates the buyer has stepped in and trying to take the price higher. If pin bar appears after a strong down move, it indicates that the sellers has lost its strength and the buyers has stepped in to move the price upwards. To keep a pin bar, we must look at other confluences to confirm our bias. We will discuss this later on. But if we find a buying opportunity as a pin bar, we can place a buy order above the high of the pin bar. Pattern number two, bearish pin bar. The bearish pin bar is just the opposite of bullish pin bar. It is a red candle with small body, a large wick above the body, and a tiny or no wick below the body. It indicates a reversal to the downside. The psychology behind this pattern is very simple. The price open here and the buyer start to move the price to move the market upwards. They covered some distance and created this high. The sellers get into the mood and push the price downwards, crossing below the opening price. The sellers then meant to push the price down and the candle closes new at loss. This indicates that the sellers has gained advantage over the buyers. Pattern number three, doji. The doji candle is probably the only candlestick pattern that has no directional bias. However, it is essential to understand this pattern. A doji candle is characterized by a candle with approximately equal wicks above and below a small body. The open and close are somewhere in the middle of the candle, and the body of the candle is very small. It shows the buyers and sellers were very competitive during that time period. Sellers trying to push prices down, but the buyers push the price upwards. In the end, they are equal to each other and price closed newly open. In itself, the doji tells us nothing, but if you see few doji in a row, the buyers and sellers are battling for a win. Usually after such a pattern, the price will generally break out a wide move in either direction, so keep that in mind. The three patterns covered up this point, a single candle pattern, and we will move to intermediate patterns that consist of two candles. Number four, bullish engulfing bar. A bullish engulfing bar is a two candle pattern where green candle is completely engulfing red candle. This means we first see red candle before green candle. Then the next candle is a big green candle that is completely engulfing red candle. The higher the green candle is higher in the higher of red candle. Similarly, the lower the green candle is the lower in the lower of the red candle. The psychology behind this pattern is pretty simple. The sellers were in control during this red candle. Then, as the new candle opened, the sellers took the price lower. It broke the previous low, and suddenly the buyer stepped in. They overwhelmed the sellers and brought the price beyond the last candle high. This means the buyer are now in control and ready to take the price higher. See you in our next video. Like, subscribe, and share. Do it to comment.